first we talk about the basic concept, right? So accounting is very simple. You basically assets minus liability equal net assets, or stockholders' equity. So, and then yesterday we talked about the balance sheet. Whatever transactions happen, ultimately it happens in a balance sheet. And today we're talking about the income statement. Income statement is really a temporary, basically revenue minus expenses, and then get the net income, and the net income flow to impact the balance sheet again, right? So today we're going to just zoom in to the income statement as part of the statement. So the learning objective is to describe common operating transactions and select appropriate income statement account titles. Account titles, revenue, expense, like that. Very simple. So operating activities include buying goods and services from suppliers and employees, and selling goods and services to customers, and then collecting cash from them. That's it. All business is this, just buying and selling. That's all it is. And as a business, you're at the center of managing it. So you buy goods and service, and then you pay cash to suppliers and or employees. And you sell goods and services, you collect cash from customers. So that's the 4 steps to break down. Okay. So let's look at, like, the business receives $30 of supplies, and the business give a promise to pay $30. How does it think accounting-wise? You increase supplies on the balance sheet, right? So, or you can say debit supplies in the balance sheet, $30, and accounts payable, $30, right? We increase. That's how you impact the balance sheet. Okay, so you start to think this way. Okay, and then all these exercises just like that. So you train your brain. So pay cash to supplier and the employee. So the business receives releases from $30 promise. The business gives $30. Okay, so you reduce cash $30, give out, and then that accounts payable also reduce $30, right? So accounts payable reduce $30, and cash reduce $30. So that's how it impacts the balance sheet. And then collect cash. Sell goods and services. The business receives the right to collect $50. The business gives service at the price of $50. So it's revenue $50, right? You increase revenue $50. And then you accounts receivable, because they haven't paid you. So you will collect $50, right? So accounts receivable increase $50. So assets increase $50. And then, revenue increase $50. Okay. And really the revenue increase $50 right now without considering the cost. You're increasing what? The equity, right? The stockholder equity $50. So in a way, the balance sheet always balance, right? So $50 goes there. And then the business receives $50 cash. The business gives up the right to collect $50. Okay, so you increase cash $50. And then accounts receivable reduce $50. Does it make sense? Making sense? Okay, not making sense in the back? Nodding. Okay, good. Yeah, that's all accounting is about. Okay, that's the story. So we say accounting is the language of business, right? So you express that, and then eventually goes to the balance sheet. Income statement. So here the income statement, basically 3 big items, right? Revenue, expense, net income. So it's basically revenue minus expense equal net income. That's a big one. And revenue, you can categorize them into different revenues: sales revenue, service revenue, and you can say, in your medical device, you can say whatever part related medical device revenue, insulin revenue, whatever, right? For you can be specific, and so tell your story so people understand your business. And expenses, you have salary and wages, rent expense, utility, insurance, advertising, income tax, right? And you can make it more specific for your wedding. You can say cameraman, DJ, you can all be specific. You can say salaries and wages, and then under that, you can salaryman, you have cameraman wages for the planner, for suppliers, blah, blah, okay? So that's how you design your business and design your chart of account to create a budget, okay? So I always like to use a category level, summary level, and then have details. Yeah. And that also, it's easier when you put into QuickBooks. The detail level, it helps the bookkeeper because it's more specific. They don't have to ask questions. And then the summary level, it's easier for you to read because sometimes you don't want to see the details, right? So. So here, make sure, be professional when you prepare the report. Always put the title, the name of the company, and then the title of the statement, income statement. And then for the months of, so make it the time, okay? So make it specific, be professional. So the easiest way is cash basis. Cash basis is basically cash in and cash out. So cash basis, you don't book accounts receivable or accounts payable. So cash basis basically when you sell, if you haven't received the cash yet, you don't book it. When you receive the cash, you have sales. And then for expenses, if you haven't paid it, you don't book it. When you pay it, you book it. Okay. So cash basis is the easiest one for small businesses. But cash basis is not the most accurate one because a lot of time in business, right, you sell it. It's not like every time you receive cash right away. And if you don't book it, you forget to collect. Yeah, some people honestly they pay you, some people they don't pay. You don't know, you don't keep track of it. So the best way is accrue basis. Accrue basis is like what we did it. You sell, you generate. As soon as you sell it, you book revenue and accounts receivable. Okay, so now you keep track of it. And then you look at your aging of accounts receivable by clients. And if they haven't paid it, you call them, right? So that's how you do. So cash basis, if it's no cash received, but cash is paid, the expenses, you paid out already, and then you receive whatever you receive, you book in there in the expenses. So a lot of time cash basis also cause a problem of not matching it. Like this month, you have a lot of expense, but no revenue booked, and it seems like you have a big loss. Or this month, you have a lot of revenue, but no expense booked. Right? So accrue basis also help to match the expense and revenue. Learning objective 2, explain and apply the revenue and expense recognition principles. Okay, so we talked a little bit. So this is called a GAAP. So GAAP requires accrue basis. Accrue basis basically requires revenue when they are generated and expenses in the same period as the revenue to which they relate, regardless of the timing of cash receipts or payments. So this is called a matching principle. So the revenue, you try to match the revenue and expenses. Okay, so if you sold in the previous case, $50, that cost $30. You try to put it in the same month using accrue basis. Okay, when you sold it, you book revenue and accounts receivable, and then then at that time you also look at the cost of goods sold, and so this way it generates the income statement. You have made $20. Revenue timing of reporting revenue versus cash receipts. Revenue recognition principle. Revenues are reported when the seller provides goods or services to its customer in the amount the seller expects to be entitled to receive. Okay, once you deliver, you book revenue. So this it's kind of very detailed way of looking at it. You know, it helps you, but in reality, it's very simple. You know, you sell it, you book revenue. Okay, so identify the contract. As an accountant, you look at the contract, you see, you know, what products, service you are performing, and then determine the transaction price, with the amount, and allocate the transaction price to the performance obligation. Sometimes it's a long-term contract, but this time it's only, 10% of it. You know, you allocate that, recognize revenue when each performance obligation is satisfied. Okay, so you book it. But the bottom line thinking is very simple. You deliver the service or you deliver the goods, you book revenue for whatever amount that you agreed on the contract, and the book receivable. Yeah, that's it. That's revenue recognition. So as we talked about these concepts, yeah, the steps. So revenue recognition. So basically, you know, your cash received, promise given. So when you receive the cash and you made a promise but you haven't delivered the service, even you receive the cash, it's not revenue yet. So you increase cash or debit, you know, assets, debit the cash, right? You increase cash. The other side of it is not revenue. So it's a liability. Okay, you can call prepaid, you know, prepaid revenue. You can call that way. So actually it's a liability. You owe them, basically. That's the idea. And promise fulfilled, service given. Now you now you reduce the pre-earned revenue or unearned revenue, whatever you call. Reduce that and then increase revenue. Yeah, make sense? The process. Yeah. And then cash with sales, when you receive the cash, service given. So that one, it's easy. You cash, so you increase cash, right? Debit the cash on your balance sheet, and then your income statement, you have the revenue. So you credit revenue or increase revenue. Okay, so that makes sense. So sales, service before and the cash after. So right received, service given. So you receive the cash, and then the service immediately you deliver, then you book revenue directly. You don't need to book unearned revenue. Don't book liability anymore. Okay. And then cash received, the right given up. So if you no revenue at this time, so which means you receive cash, and then you but you haven't provided service yet, right? So again, here is a no. Here this means service given. So increase cash, and then you increase revenue. And what does this mean? Cash received, the right to give up. So you receive cash. All here means that, right? This means not to receive cash. Okay. So this is accounts receivable. Accounts receivable. Okay. So this means accounts receivable. You're right to receive, but you didn't receive cash. So you book accounts receivable and then increase revenue. So basically debit accounts receivable and the credit revenue, right? You increase revenue. And then here you basically you receive the cash and you reduce accounts receivable. Okay, these two steps. Make sense? Okay. Kind of getting technical, but I try not to use debit and credit because that's confusing. I rather use increase and decrease. Okay. So that's where you understand. And then you kind of picture, how these things impact the balance sheet and the income statement. Record expenses in the period the underlying business activity occurs. So in this case, cash before expense. It means you pay cash for supplies, for example, but it's not expense yet. So the supplies is an asset, is an inventory on your balance sheet. So in this way, cash you given out, so reduce cash, and then assets, your supply inventory increase, right? both happen in the asset side of the balance sheet. One increase, one reduce. You are basically exchanging one asset to another asset, reducing cash and increasing supply. And then supply used up. When you use up supply, now you book expense. Okay, so you book increase expense and you reduce cash, right? So, and pay cash for electricity used up. So you basically, okay, electricity expense, and then your cash reduces. All good? Good, good, good.
Okay, so,
Yeah,
so debits are basically like increase and credits are like decrease.
yeah, for the assets, debit is increase, and then credit is decrease. Okay, for the liability, debit is decrease, credit is increase.
So
Yeah, yeah. And then for the revenue, debit is a decrease, credit is increase. So credit, the revenue and liability are the same. Okay, expense and assets are the same. Expense and assets both. You debit, you increase. You credit, you decrease. If you look at it, and then so assets and the expense are the same category. You debit, you increase, and you credit, you decrease. And then liability, equity, and the revenue are in the same category. So you credit, you increase. You debit, you decrease. Yeah, and it makes sense if you really look at it. The expense actually is assets. If you really look at it, right? It's another asset because the expense you pay cash, and then you know got some expense or got some supplies. These are all the assets in a way. And the revenue is, if you look at it, it's really shareholder equity, right? It's your money. You know, so you put in same with the shareholder equity, and also liability. Well, liability is kind of the increase the cash. So in a way, it's also the same category. It gives you money. So that's how I thought. That's how I think. If you want to think from debit and credit, yeah. But I was not able to distinguish when I was a student. I was just confused in the classroom. If you can just use awesome. But you don't have to. I just want to tell everybody, if you get confused about debit credit, don't even think about it. Okay, just think of increase and decrease. And then, I would rather you have the confidence than be like, So expense before and the cash after. So advertising service used up. In this case, you have the expense increase and then the liability increase, which means the liability is accounts payable, right? You need to, pay them and pay cash for advertising. So basically now you pay cash, so your cash reduce, and then your liability also reduce. You don't owe them anymore, right? So your accounts payable also reduce. Yeah, that's how it happen in your balance sheet. Okay. So now analyze, report, and summarize the effects of operating transactions using the accounting equation, journal entries, and T accounts. Okay, so we did that one last week. So this is again step-by-step tedious manual process. And we will still learn that so that you know how it happens. And someday, if we went to a dark age, no computer, no electricity, you can still do it. Okay? But the reality of it, nowadays, all of these things are done by the computer. Okay, you use QuickBooks, you basically go there, you enter the journal entry, and it automatically goes to your balance sheet. There's no T account. There's no so-called trial balance. Okay, there's no these manual tedious steps. Okay, so but let's go through that anyway. So remember, we have the assets like plus equal liability plus the stockholder equity, and then the assets, increases on the debit side, the liability, liability and the stockholder equity increase on the credit side, okay, decreases at the debit side, okay. And then, common stock, that's equity basically, and then retained earning, it's, same, it's also increases. So basically, the stockholder equity is made up of the beginning balance of the stock equity plus the net assets, okay? Or whatever new common stocks you issued this year. So the revenue and expense are really temporary accounts. It goes to the net income of the retained earnings section. Okay, so the real number goes to your balance sheet is the net income. Goes to retained earning, and then the retained earning, after you distribute, the balance goes to your balance sheet in the stockholder equity section. Okay, so if we really look at it, the entire accounting is just one balance sheet. One balance sheet, and this is temporary. Revenue and expense is temporary for that month, right? So really, like your business, if you look at a business, the real business is the balance sheet. That says what you have, how much you owe other people and what your net is. That's the real business. Okay. And then the income statement shows your ability to generate income. How much net income are you generating every month? So the bottom line is your net income, right? It's not your revenue. No matter how much your revenue, if you overexpand, you still does not make any money. So watching expense, that's smart, you guys, with a medical device to begin with. So let's look at the example. Sell games for cash. In September, Noodle Cake sold $3,000 of games online. Okay. Let's see. Your cash increased $3,000 and the revenue increased $3,000. Right. And that revenue increased $3,000 with, without expense booked. Right now, actually, in terms of impacting balance sheet, it goes to the stockholders' equity. So in a way, it's like a cash $3,000 and stockholders' equity $3,000 increase, both increase on the balance sheet. Right? Make sense? Okay. And then you recorded cash $3,000 and sales revenue $3,000. That's the journal entry. Okay. And then you put into the T account, the cash T account, you put into the debit side, a $3,000 increase, and then the sales revenue, you put into T account, and the credit side, $3,000 increase. So the balance of now cash is $23,700, and then the sales revenue is $3,000. And that, if this is the end of the month, that balance goes to your trial balance sheet, trial balance. Okay. And then in the trial balance, now you move around. Some, go to the asset section, some go to the liability section, then it's a balance sheet. Receive cash for future service. Issued 3 gift cards at the beginning of September. Receive cash, okay? So cash, increase cash, $1,000, right? Now, the other side of it, you haven't delivered, so it's a liability. You put in the liability section, defer the revenue. Yeah. And deferred revenue, some people call unearned revenue, some call it deferred revenue, whatever it makes sense. Or you can say, pre-sold revenue, right? Something like that. And one thing you want to learn in business is the pre-sale. Cash is always key. If you can pre-sell, pre-sell. So one of the good way I really like is if you have innovative product, you pre-sale on Kickstarter, or nowadays there are a lot of, at least I know 3 platforms: the Republic, Start Engine, and WeFund. These are crowdfunding engines. You go there, you pitch for your business. And then the beauty is, because I do that, so I know it. The beauty is, if I like your video and invest in your business, I most likely like your product. So I would go online and order the product. Now you don't have a product yet, it's just a video introduction. So you receive the money already. So it's, you have cash increase, right? And then you defer the revenue. Okay. Now you go and find a supplier, and manufacture and build your product. This way, it's so much lower risk. You pre-sold it. So business, as Peter Drucker says, it's all about marketing and innovation. That's the key. You want to innovate ahead of people. And you want to compete on price. You want to innovate. And people like you because you are the only one they can find. Okay. And then you market it really well. That's how you build your success. Yeah. Like for me, I do very innovative strategic tax planning. So people, if they had a chance to listen to me for half an hour, my price is ridiculously high compared to other people. It's like, but they like it. They really want to work with me. They don't mind because they really can't find somebody else, right? So you start to train yourself to think innovatively. And these are foundational thinkings. You know how the accounting works. And then, like in tax planning, you know the business. And now you understand the accounting, how it works. There's so much flexibility, right? In terms of cash basis, accrue basis, and when you book revenue, when you book expenses, how you book expenses, what should be expenses, what's going to be put into revenue, or you move around this year, that year. There's so much flexibility. Most people don't understand. And now you, as an accountant, you have the skills. You can save them so much money on tax planning for anything, right? It's like really think about this entire thing. It's an art. It's a story. As long as you understand the principle and follow the principles, now you can be creative, right? So that's the beauty of it. Of course, you need to follow the guidelines. Make sure these basic guidelines are followed. Okay. Or you have inventories, right? You have a huge inventory, but this year you also have made a lot of money and you have to pay tax. Well, you can say some of the inventories, who knows, right? You may write off some of the inventories because they're obsolete, assess it. So then you can reduce your profit this year, right? Well, next year, some of the inventory is sold, it's good. Yeah, you add it back, it's fine. Okay. But it gives you some leverage of your cash flow, at least, right? So these are flexibilities that you can think once you understand it. So I always say you go inside the box and understand how the box is made. That's all these principles. And then you can come outside the box and be creative. Yeah, that's where the value that somebody who knows accounting or not will make a huge difference. And whether you be a business owner or a CFO or an accountant for your clients, these are the values you can provide. Now you probably understand, like, accounting is really neat and cool, right? It's really, it makes a huge difference. So you have cash and you have deferred revenue. Okay. So like really whatever business you have, try to pre-sell. Try to pre-sell. I have friends, they try to, like publish a book and then they start to pre-sell and it's like, what, $14? I just buy, I never received that book, honestly. I already forgot. But, they did this for millions of people, it's like $14 with million people, that's $14 million already. Now, who remembered? Even if they send me the book, And it's like an online book. Even they send me the book, I don't even remember to read it. Think about that. That's our business. Even they send me an email, it's in a junk email anyway, so. So pre-sale, I think that's the best thing. So basically this is a tier count, you know, you put it in there. So I'm just gonna quickly run through it, okay? So now you sell it basically, but you haven't received the money, so accounts receivable, say, increase and revenue increase, right? And this one, now you pay, you receive payments, so your cash increase, receivable reduced. And you pay cash to employees, okay, reduce cash, and then you have wage expenses, right? And you pay cash in advance for the 3 months rent. So it's cash reduced. And then because it's 3 months in advance, so you don't book it into the expense yet. So you book into prepaid rent. So it's still your assets. In a way, it's a deposit, right? So it's you reduce one asset, cash, and increase another asset, prepaid rent. Okay, and now every month you basically reduce the prepaid rent. So now, okay, I'm gonna go back to this one. Let me ask you. So, how do you do it? Now it's say September 30, and you want to do the rent, book the rent. How do you do it? So rent expense, right? Whatever 7,000 divided by 3, I guess this monthly. And then you reduce the prepaid rent, right? It's same like you paying, it's like accounts receivable, it's same theory. So, okay. And then by the end of 3 months, you expense all the $7,200, and then you reduce that account, prepaid rent, it becomes 0, right? So that's how it works. So here, include cost to be paid later. Display the online ads in September, receive the bill for $500 to be paid in October. Okay, so accounts payable, and so you increase expense this month, right? So accounts payable and expense you booked, and then so the net income is the net income actually reduces by $500, but the reality is the expense increase. This is a bad example. It's confusing. So this is net income reduced $500, but what it did is a advertising expense increased $500. Okay, so this is McGrail. I don't think it's a good idea to do this way. It's confusing. So they basically say this net income reduced $500. So what they wanted you to think is this is a temporary account. It causes the increase of advertising expenses caused the decrease of net income $500, and then this will actually the impact on the balance sheet is you have reduced stockholders' equity $500. Okay, you get that? Okay, they kind of jumped one step. Okay, the real step, the first one is advertising expense increase $500. Okay, and then liability increase $500, and that's but the net effect is you have a net loss of $500, and then it will you lose $500 equity in a way. Okay, so then still liability $500 minus $500, that's 0. Okay, so that's how it works. So advertising expense increase $500, and accounts payable increase $500. goes to the T account. Pay cash for expense. So by its bank that an automatic monthly payment of $600 was transmitted to its utility company for electricity use. Okay, cash reduced it's $600, utility expense, you increase $600. Okay, which is the impact is net income, lose $600, reduce $600. Okay. So that's how all the T accounts come together. And then manually, you total up the debit side, the credit side. If it's asset, usually the balance sheet, the balance is on the debit side. And then you move this amount, total all of these up, right? And then you move this around, put it into one aggregated, called a trial balance. So it looks like this. Yeah, that's how the next step is. Yeah, and then you start to aggregate, putting these together. These are the assets section of the balance sheet. These are liability section of the balance sheet. This is the equity side of the balance sheet, and this goes to the income statement as revenue, and this goes to the income statement as expense. And it creates, so this was the one that's transferred, right? So these are the one transferred. So, so before that, I want you to understand this part. So eventually, this trial balance sheet, all you do is categorize it to create the income statement and the balance sheet. Okay, that's how you do it. And this is just one transition step where you can calculate, and eventually these two numbers, debit and credit, are equal. And in the old days, when I was the first accountant, on Friday, 5 o'clock or 6 o'clock, I try to calculate, and it's like $1 difference. It's just balance. The balance, this two numbers does not balance. And usually because it's a typo, okay? I wrote it and then I review again, and calculator, type, at that time there's no computer. And at the end, it balances. Oh, hallelujah! I'm so happy. What we can. That's all accountants do in these days. And it's enormous labor. But I did this like for 3-4 years. By doing this many times, it's like now I say, okay, whatever you say accounting, it's like in my brain, this is like a computer. So there are a lot of homework, you play with it and then you understand this. So in the future, they give you a balance sheet, you know where it is. And then they just tell you one transaction, need to adjust, like whatever it will impact your savings. You can make an adjustment. Okay. And then, adjustment again, like from tax perspective, many things, something you can call assets, something you can just like, okay, this year we have a lot of income. Well, you just don't need to call it assets. You can just expense it, right? The supplies you borrowed, you bought it, instead of putting on balance sheet, you can just say, okay, expense it, right? This year we do some income. Okay, so that's how you can do it. Or you know that this year, next year you could make a lot of money, right? This year it's already a loss. Okay, you put it into assets section. You put in inventory supply. Okay, now next year you can expense it, right? So you really think about the timing, right? It's actually arbitrary. December 30 is a arbitrary. So you can do this artfully as well, within the business logic. So review of revenue, a cash received before revenue is generated. Okay, you have cash increase and then you defer the revenue, right? And then when you deliver the service, deferred revenue reduced, and then you book recognized revenue. Okay. And then cash at the same time as revenue. So you basically receive cash and then you book revenue. Cash received after revenue is generated. So when you generate revenue, you recognize the revenue, and then instead of cash, you say accounts receivable. It's also in the asset section. And then when you receive the money, you increase cash and reduce accounts receivable. Making sense? Good. Everybody nodding? Cool. The girls in the back, are you paying attention? Are you getting it? Okay, cool. Thank you. I want you to get all of these because these are foundation. Once you lay this foundation, in the future it's easy. Yeah. So cash paid before expense is incurred. So it's not expense yet. So prepaid, that's like the rent, right? And then you reduce cash. And then when you recognize it, you increase expense, reduce prepaid, right? Again, this is confusing. You know, I tried in the beginning, you don't need to think jumping steps. You just here, you should think just increase the expense. Okay, reduce prepaid. That's the easiest way. Okay, I don't like that they make it a kind of jump step. You know, the net income thing. You don't need to think that way. That's confusing to me. Okay, so make it simple. It's basically here you increase expense or debit expense, and then you credit or reduce prepaid. Okay, so that's how you think. And then you use up the benefit. You cash at the same time as expense. So you basically pay cash, reduce the cash, and then you increase the expense. Cash paid after expense is incurred. So when you have an expense, you book expense, and you haven't paid, you book liability. You haven't paid them, so you increase accounts payable. There's a liability into the liability section of the balance sheet. And then when you pay cash, you reduce cash, and you reduce the accounts payable. Okay. Making all sense so far? Okay. So these are drills. You understand, and then you do some homework. These are just drills. You know the drills, playing basketball, everybody play basketball. I learned it. Okay. Playing basketball, you play this drill, right?
Oh, yeah.
It's like numerous drills. And then eventually you feel like, damn, this ball is like sticking on my hand, right? That's how you feel. That's how you play drills. You need to play some drills. Yeah. Okay, so the net profit margin. So you have the remember this is the trial balance. So you look at this, these are the revenue and expenses. So you put it into your income statement. Now you have just net income. Okay, and that's net income. And the net income margin, this is very important. This is net income divided by revenue. That's the margin. And that's your profitability. Okay, so I would expect at least your business should have a high margin. When you want to have a high margin, net income high, which means your revenue, the sales price is high, and your cost is low, and then your high margin. So in business, there are basically kind of two types of business model. One is you can have a very high margin, high sales price, and low cost. And then the scale is not as important. And I think these are, I like these businesses. It's easier. It's less work. Okay. You have small transactions, but high margin. In terms of like my own service, I serve the high end. People have a lot of tax to pay, and I can save them a lot of money, and I can charge them a lot. So I don't have to work with a lot of clients. Okay. So another business model is the Walmart model. Basically, You can have low price but high value, high volume. Usually it's difficult to do both, okay? So you pick one better, either high price and a high ticket and a high margin. And then you can, you know, a bit easy. That really usually requires innovation. If it's a product, it's very innovative product, you know, you have good technology, or you are ahead of the curve, your information is good, right? If it's service, usually requires, you know, high talent. Be it like, you know, tax or CFO, you know, consulting services, or, you know, like doctors, legal services. These usually requires you are very good at what you do. Okay, refine your skills. So income, net income, income statement limitation. Net income is not cash, not necessarily cash, because what? Because some net income is just accrued, right? It's accounts receivable. You haven't received the cash. So don't confuse income equals cash. You didn't receive this much cash. Okay. Net income does not equal, you know, change of value. Net income is not exactly, it's not exact. There's a lot of estimates, okay? And some monies you may never receive. You sell accounts receivable, but you know, they go bankrupt and they don't pay you. Okay, so what time is it so far? Where do I see my time? What time is it, anybody?
2:36.
2:36, okay. So let me see if I want to go through this. Let's just go through these quickly, helping you. Do you want to go through these?
Wait, can you help me with the problem on the homework?
Yeah,
So I don't know how you find the income statement cash using those numbers.
okay, let's just put this, disconnect this. Can you connect this? Oh, no, this one does not work. Okay, so, let me see it.
On these sides.
So it says, chapter 1 assignment,
I think 12.
part 1-1 and the 1-2. I'll go preparing an income statement of retained earning and a balance sheet and interpreting the financial statements. Okay, assume you are the president of a high power corporation at the end of the first year of operation. The following financial data for the company are available. Accounts payable, 33,000, accounts receivable, cash, common stock dividends, notes payable, operating expense, other expense, sales revenue, supplies. By now, how much did the cash increase or decrease? Which financial statements will report the business activity responsible for the change in cash? Okay, so I think this is not the full thing, right? So there's more. So
That's all it gives you. So you have to check for the income. That's basically.
yeah, basically you look at the revenue, you know, minus expenses. And then that's creating the net income, right? And the net income, you know, flow to your balance sheet. And then you have the accounts receivable. Yeah, I think we need to. Here's the thing, let's do this. After this class, let's look at this together. And then. Okay. Book a time on my website.
Sounds good.
Yeah. Time with Jin Hong. Okay. So if you needed to talk to me one-on-one, timewithjinhong.com. JINHONG.com. Okay. Book a Zoom meeting with me. Yeah. So I think, do we have time to go through this? What time is it? 2:39. Okay, let's quickly go through this. Okay, it may help you to do your homework. Identify accrual basis revenue. The following transactions are July activities of Bill's Extreme Bowling Inc., which operates several bowling centers. If revenue is to be recognized in July, initiate the amount. If revenue is not to be recognized in July, explain why. Okay, first, Bills collected $12,000 from customers for services related to games played in July. Okay, so that's they already played in July. So that's revenue, right? So you book, always think of book cash $12,000 and the revenue increase $12,000, right? So that's how you book it. And Bills billed a customer for $250 for a party held at the center on the last day of July. The bill is to be paid in August. Okay, so this is still in July. So that's the bill customer for $250. So this is revenue in July. You should book, right? So revenue in July increased $250. So you credit revenue and then accounts receivable, right? Does it make sense? Or anybody, you can tell me how it works. Okay, the men's and women's bowling league give Bills advance payment totaling $1,500 for the fall season that starts in September. Okay, so that's money received, but the service hasn't been delivered, right? So you increase cash, $1,500, and then you increase what? Unearned revenue, or whatever you call advance. And then Bills received $1,000 from credit sale made to customers last month. Okay, when it happened, it was a receivable, right? Credit sale. Now you reduce the receivable, basically. You increase cash, reduce receivable. Okay, so. Okay, so this one, identifying accrued basis expense. The following transaction are July activity of Bills Extreme Bowling. Okay, it's still the same, I guess. Bills paid $1,500 to plumbers for repairing the broken pipe in the restroom. That's easy. You just pay expenses and then reduce cash. Bill paid $2,000 for the June electric bill and received the July bill for $250, which will be paid in July. Okay, so the June bill was paid. Okay, now that's already booked previously, right? So you basically reduce accounts payable and reduce cash. And now the bill in July, you need to book it as revenue. Yeah. And Bill paid $5,000 to employee for work in July. Oh, of course, that's expense. Yeah. So I think you get it. So these are things,